Alpha, wake up! The brokerage app is broken. I think there's a glitch in the data feed. It is January 2026. Look at these numbers. They shouldn't be possible in a mature asset class. Silver isn't just moving, it's teleporting. We just closed the books on 2025 and the scoreboard is absolutely startling. Silver rose 150%, gold gained 66%. Both of them just left the NASDAQ, which, had a decent year at 21%, completely in the dust. It is aggressive. It's also terrifying if you know your financial history. Are we staring at a house of cards built on panic, bad logistics, and a whole lot of FOMO?
No, we are witnessing the most aggressive repricing of precious metals in modern history. That is the trillion-dollar question. Let's dig a little deeper into it. My take is that we are undergoing a permanent monetary reset. The rules of the game have fundamentally changed, and the market is finally waking up to that reality. It's because of one boring banking regulation, Basel III. The most important event of the last year wasn't the election. It was the global harmonization of the Basel III banking protocols. They took full effect in Europe and Asia last January. In this regulation, it didn't just tweak the rules, it fundamentally changed the identity card of gold. It's the difference between an asset and a liability. So, under the new Basel III framework, allocated physical gold, specific bars certified by the London Bullion Market Association, now carries a 0% risk weight. That means for a bank, holding a physical bar of gold in their vault is now legally the same as holding a stack of cash or US Treasuries. It's Tier 1 capital. It is the bedrock of their solvency.
Right, but banks have always traded gold. Why the panic now?
Because the regulator took a sledgehammer to the other side of the trade, paper gold. Imagine unallocated gold is like a gym membership. You have the right to use the gym, but you don't own the treadmill. If the gym goes bust, you got nothing. Basel III now says to the bank, if you sell that membership, you have to treat it like a radioactive liability. Basel III assigned these unallocated positions a punitive 50% risk weight, which effectively kills the paper market. It makes it toxic. For every $100 of paper gold a bank holds or sells, they have to hold $100 of pure capital reserves against it. That isn't banking, that's economic suicide. It just ties up immense amounts of cash for zero return. So the banks are forced to dump the paper and buy the actual metal. This regulation forces them to hold 100% capital against paper positions while requiring zero capital for physical. The math is just brutal. Global banks need an estimated 8,000 to 10,000 tons of additional physical gold just to meet their capital adequacy ratios. That creates a structural supply deficit of 2 to 3 times the entire global annual production. This isn't speculation, this is a compliance mandate. They aren't buying it because they like the shiny rock. They are buying it because the law says they must to stay in business.
Okay, I see why you're emphasizing the regulation. But I'm not convinced that this compliance scramble explains a 150% move in silver. Silver isn't a Tier 1 banking asset under Basel III in the same way gold is. Excuse me. What we're seeing in silver, it screams clustering illusion. Investors are looking at gold, seeing it go up because of these banking rules, and then they're just blindly buying the more volatile asset, silver.
But silver has always acted as a levered play on gold's monetary function. When gold runs, silver sprints.
Or it acts as a trap. Look, the shortage we're hearing about is logistical, not geological. Look at the inventory shifts. The London LBMA vaults are draining at a record pace, yes. But where is that metal going? It's not disappearing into a black hole. It's moving to New York. COMEX inventories just hit record highs of 1.6 million tons. This isn't a global lack of metal. It's a panic driven by President Trump's 2025 designation of silver as a critical mineral and the subsequent threat of tariffs under that Section 232 investigation.
You're referring to the National Security Order.
Right. Traders got wind that Trump might just slap a 25% tariff on imported silver. So what did they do? They panicked. They drained London to move metal into the US before any potential tariff could hit, and that created a localized squeeze in London, driving up the price there. It's a supply chain hiccup, a tax avoidance scheme, not a fundamental revaluation. We're confusing a shipping problem with a monetary revolution.
I think shipping problem is a massive understatement. I think you're missing the forest for the trees. You call it a logistical squeeze, I call it the end of the paper suppression scheme. The gamesmanship you're talking about is actually the banks acknowledging the new reality. Look at JP Morgan. They increased their physical gold holdings from 120 tons in 2021 to over 850 tons by the time the rules hit. That's a 608% increase. Wall Street effectively front-ran this whole regulation. At the same time, they cut their paper trading volumes to almost nothing. They knew the paper game was over.
Okay, that's a compelling narrative, but couldn't they just be profiting from the spread they helped create?
It goes beyond just profit. It's survival behavior. Banks like Citibank suspended paper gold accounts entirely last month. Now, why would they turn away customers? Because, under Basel III, the business model is impossible. They aren't just trying to corner the market for a quarterly bonus. They are trying to make sure they are still banks in 2027. The Bank for International Settlements, the central bank of central banks, effectively admitted that paper gold is a systemic risk. The shift to physical is an acknowledgement that in a crisis, unallocated gold is worth zero.
I'm sorry, I just don't buy that the current price action is purely rational compliance. If this were just banks quietly shoring up capital, we'd see a steady rise. Instead, we have a vertical line. This is where the mechanics get messy, specifically with what I call the ETF trap in silver. The ETFs are just tracking the price.
No, they are exacerbating it.
See, silver ETFs hold very little physical metal relative to the demand for their shares. But here is the kicker. As prices rise, the authorized participants, the big banks, they have to buy physical metal to back the new shares. Usually they buy this in London because it's the global hub. But remember what I said? The London vaults are empty because everyone moved their stash to New York to dodge those potential Trump tariffs. So the demand is real, but the metal is in the wrong place.
Exactly. The ETFs are chasing metal that isn't where it needs to be. This is a technical squeeze. It's a supply chain lockup. When an ETF has to buy metal regardless of price, just to match share creation, price discovery breaks down. And historically, when prices detach from reality because of technicalities, the market doesn't just stay high. It crashes when the bottleneck clears.
If that tariff threat resolves, or if the logistics just sort themselves out, that premium on US-held metal evaporates.
I think you are placing way too much weight on the tariff narrative and the ETF plumbing. The move of gold and silver from west to east is about something much more simple: possession. Basel III incentivizes possession. If you don't hold it, you can't count it.
The macro picture is undeniably ugly. I won't argue against that.
Ugly is putting it mildly. We have to talk about what happened last year. The Department of Government Efficiency, DOGE, led by Elon Musk, was the market's last great hope. The whole narrative was that Musk would come in, slash the bureaucracy, balance the budget, and save the dollar, and the reality fell a little short.
It was a failure of political will, certainly. But I mean, markets have ignored deficits for 40 years.
But the bond market isn't ignoring it anymore. The failure of DOGE was the psychological breaking point. It proved that the system lacks skin in the game, and that is why the World Gold Council reported that 76% of central banks plan to increase gold reserves.
We're approaching World War II levels of debt to GDP.
If the US government can't stop spending, gold becomes the only anti-fragile asset left.
Okay, let's move to our closing thoughts. Buying during a squeeze usually leads to losses when the logistics normalize.
To summarize my position, this is the ultimate judgment of physical assets over virtual ones. The paper era is over.
My closing thought is, I'm going to the backyard. I'm digging a hole. I'm becoming my own central bank. I'm okay. Basel III made me do it.
Thank you for watching. If you liked this video, please do like and subscribe.
Wait, don't leave me alone with the charts.
Class dismissed. Like and subscribe for more alpha.
Do it, or I'm buying more meme coins. Help!